Yesterday I posted about bonus depreciation sunsetting and going away basically now. And I got a lot of feedback on asking what it really means, what's the consequences. And I figured let me do a video about the topic of general tax advantages in real estate, but specifically depreciation, and then into where it's relevant to what I posted yesterday. It's going to take a couple of minutes, but if you bear with me, I think you'll find it informative. The first thing that people know about tax benefits in real estate is that there is tax benefits, and my accountant will figure it out. The problem with that is that if you don't know the basics of its benefits, you might be leaving money on the table by choosing a deal which doesn't fully maximize that benefit. The next thing that people think of is kind of loopholes. And the truth is, most of what you benefit from owning real estate is not loopholes, but they're very basic and common sense concepts, which the government also understands is worth it and makes it a win-win for the government and the people and the investors. So today I want to focus specifically on depreciation. Number one, it plays a huge role in the whole conversation of tax benefits. And number two is it's a lot more specific to what I posted yesterday. And depreciation really is not unique to real estate per se. It is true with anything, any business that owns a piece of equipment or stuff that loses its value every single day. The truth is, that is just a basic accounting principle that you have to pay taxes on income. You have to calculate income so you can pay taxes on it, but then you can offset that with losses. And losses typically are not just what you paid money for. There are paper losses as well. In this case, depreciation is counted as a loss because you own something that just lost value. That is considered a loss. In real estate, practically, the ratio between the loss that you could take on the income that it produces to offset is very large. Why? Because real estate has a lot of stuff which depreciates quickly. You have roofs on the big ones, structure, plumbing, furniture, landscaping, you name it, office supplies. Those are all stuff that lose value and is considered a loss. Now, on top of that is something that the government calls accelerated depreciation. Now, the government understands depreciation in concept, but does not have the time or the resource or wants to designate the resources to go down to every property and assess every single item where in its lifespan it is. But if you go ahead and pay for it and you have a certified engineer come down and classify everything and put it into categories of either 27 years on the big structures, 15 years on like furniture, stuff that hold for 15 years, and then 7 years and then 5 years on the small stuff, that's basically where you can bucket it into, you will be able to manipulate the tax benefit a lot sooner. And as we know, money today is worth a lot more than money tomorrow. Now, this is where bonus depreciation comes in. Bonus depreciation is kind of turbocharging everything we discussed till now. It basically was enacted in a very big way where it benefited specifically value add real estates in 2017 with the Tax Act that Congress passed when Trump was in office. They wanted to incentivize specific investments in a lot of stuff, and including real estate, where it enhances the property. It not only just is a replacement of the value of whatever you're placing. You're not just replacing stuff that went. You're actually making it a better product. You're investing in making it bigger, better. And they told you you'll be able to take 100% of that investment as a tax loss towards your depreciation. And what that meant is, in a value add deal where you actually came in and took the property, which is a C minus, let's call it in class, meaning it is not really performing at its best, or as a product, it is more to the lower end of it. And you're investing heavy money to bring it up and to become a better and more of a quality asset. So you're changing the project into better. It costed you $5 million. That $5 million, a big part of it was able to be taken in year one of that, which is why a lot of investors, and I was able to send that to my investors on the deals, were able to get up until 100% of their investment amount as a loss in their K1s. As a disclaimer, you do need to classify as being actively involved in real estate to fully benefit from that, but investors have that a lot of times, and your accountant could help you and if you qualify or not. But even if you don't, there was definitely benefits that your accountant was able to apply to your tax benefits either this year or spread out over years. The bottom line is this last portion of it is sunsetting in 2022. So now 2023 coming, any deals that get closed in 2023 will not completely lose it, but will go from up to 100% capacity to just 80%. So in a deal where it would have gotten 100%, you just lost 20%. Next year, it's going down another 20. By 2027, it completely is gone. So if you do want to take advantage of this last 100% option, two things need to happen. First of all, the deal needs to have enough depreciating items in its business plan and its structure to get to 100%. Number two is you need to act fast. You have 1 month left to find a deal that closes still this year, and its operators will go through the process of accelerated tax depreciation. Yes, I do have 2 deals now on the table. Both of them have cost seg in its plans and will give you a huge benefit in your next tax filing.